So like I said, I want to just do preliminary stuff with these icebergs, and we'll go deeper with Dave's screen share and what that's all about. But just one piece at a time. And today I'm going to talk about icebergs and give people a sense of why they work, when they work, how to play them, what they're showing, and just kind of a preliminary look. Now these numbers are coming out on the wires, plus 2.8% yesterday, plus 2.3 today. All right, so I'm going to show them how they appear on the screen share that we've been showing the last 2 or 3 weeks. Getting a lot of questions on, again, what they are, how to use them, and those are good questions. You should have those questions. I have to lower Trade the News here, or they're going to drive me nuts. The real news, guys, is going to be if they uptick, either New York or Italy numbers, Italian numbers. All right, so let's get rid of this screen. I'm going to show you a couple images. Icebergs, right? I had this as an old picture of a mountain or some edge zone stuff. Let me get my pen out and go over what these look like on the screen share that you're going to see. But what do they mean when you see them? When you get a red line on the screen share, I'm going to show you in a moment. And you know what? Let me show it on top of that screen share. Dave, you still have it. You're showing me. We'll come back to this image later. Here we are. And maybe we'll get one to show up. Now, I'm not going to talk about all the features on this new screen share, but again, it brings in all the things and makes it simple for people to see all the different order flow that's coming through, whether it's big contracts and some of the zones he has, some of this stuff. There could be several sessions just done on longs and short puking, but you'll see red lines that come across when there's an iceberg seller. First thing first is iceberg is exactly what you would think it is. There's more than meets the eye. So a particular guy is showing 23 contracts offered at a price, but he's got more. How many more? We don't know. Just the fact that there's more than the 23 is the tip. And underneath that tip, there's a whole lot more. And we'll know after he does them how many he did, how many he sold. But we do know that there is more than meets the eye. Now, I want to tell people this. This isn't the visual Dave has created, and the way he's got it is awesome, and it's great. There's other add-ons that pick up icebergs. I'm not saying, hey, this is the first time anybody's ever seen an iceberg. That wouldn't be right. But there's two things with icebergs. Number one, how to use them. Number two, the fact that because the smarter money, the people who know what they're doing are kind of following along with this, is one of the reasons why it works and then traps the people who aren't privy to it. Now, just stay with me on that. When an iceberg appears, enough people know about it to react to it and do what? When a sell iceberg appears, the first inclination for most traders is to sell it and get short. Not just sell it, but sell it to get short. And after everything you've learned, after you get short, after I get short, after anyone gets short, we turn to buyers, correct? Now, if something appears, and in this case, a sell iceberg, all right, and a lot of people sell it to get short, okay, the market generally, when it sees it, will go down. And it'll go down because of all that selling to open up short positions. But there's something unique now about this area, not just the iceberg, but the area below the iceberg. What's unique about it is you could accurately now assume that a lot of people opened up short positions underneath that iceberg because of the iceberg. Got it? Because of the sell iceberg, a lot of people sold to get short. So now all of a sudden, it's not an assumption. It's pretty accurate to assume that there are shorts in this area below an iceberg. And if there's a lot of shorts in any area above a market, it's generally going to create a magnet back up to it. Why? Because of all the buyers it created. So you get a push lower from an iceberg. You watch them when they happen. You'll see this all the time. And we talk about how it's going to go back up and retest it because of all the buying below. And the people who don't get filled do what? And just stay with me on this. When you're short and the price comes down, you got a little bit of a winner, but you're not out. The market starts to go back up to where you got short. You get anxious. I know I do. Everybody does. Even if it's still a winner, you get anxious. In fact, in this case, it is still a winner. But you look at where the price went to, okay, versus where it just rallied to, and you look at that as a lost capital. Even though you're up money in the trade, you're anxious because you didn't get filled or it bounced from the best price it went to. Now remember, you're short, you're a buyer, but you're not out. So a lot of people will raise their bid and raise their bid. And in fact, it becomes the reason for the bounce. And it becomes a reason for this area here of the iceberg and the area around it, below it. It becomes the reason for it being a magnet. It's like a self-fulfilling prophecy. It wouldn't be a magnet if it wasn't there. Because it was there, there wouldn't be shorts if it wasn't there. Because it's there, there's shorts. Because there's shorts, there's buyers. Because there's buyers, they buy it back up to where what? They got short. And then what happens when all the buyers buy it back up to where they got short? At least maybe the first time. And you see this happen all the time. It acts as resistance, at least maybe once. And that's why I say you got to be careful. It's going to be resistance until it's not. The reason why is because a lot of buyers will buy it up to where they scratch it and then they're done, right? And so it could fall back a little bit. This happens to many of your trades throughout your history, right? You get short here, it goes down, you don't get out, goes up a little bit, you say, I'll buy it here. It's up a little bit more, I'll buy it here. Goes up a little bit, I'll buy it there. Goes up to where you got short, and you're like, screw this, I ain't taking a loser, and you buy it, and now you're out, and it goes back down. And when that's happened to you, it's because you're part of a bigger group. Now, that's the group that'll buy it back up. They don't want to do worse than a scratch. But you always have the group that when this dynamic of an iceberg appearing, remember a sell iceberg, he's offering 23, but he's got a lot more. A lot of people get short only because of it. They turn to buyers because that's what shorts do. That's what shorts become. There are people that are going to also lean on that order. Now, people that have been pit traders, and there's this couple of them in here that have that background, know that word lean. I've done webinars on them in the Edge program. So when shorts are leaning on a sell order, when it goes, so does their position. Just literally, if you're leaning on a wall, and the wall in this case is the big iceberg seller, and that wall begins to fall, you get out. So this is a lean, the iceberg, for shorts. Now, what are shorts? Buyers. So when it goes, meaning price goes, because you get all these buyers chasing it, buying into it, and then chasing it up for that flutter. And sometimes that flutter has a lot of momentum and a lot of speed through it, especially if there's other things attached to this area and not just the iceberg. Let's say it's going to probably break out there anyways. Now you just jammed up a lot of extra shorts. The guys who don't get out for a winner, the guys who don't get out for a scratch, the guys who are leaning on this forever, there's always those guys will buy into it, miss it, and then chase it back up. This is why you get the iceberg to act as resistance, why it runs away from it at first, why it acts as a little resistance second, and why they blow when they go through it third. You have to know that in order to set up and react to it. Whether you trade it for momentum, whether you stay the hell out of the way, whether you use the information to understand how this flow is affecting price in this particular area. Then there's other things that I'm not going to get in today, but other things that you'll see the iceberg start there, move it lower, move it lower, move it lower. When he's done, he's chased everybody down. He's puked that order or puked that size. He's moved it, and now it could go up. He's pressed it all the way down. He's done. He's got everybody short. So he's done selling, and he's probably loaded up a lot of people short, which creates the buying, which moved us up. Now let me clear some of this. And this is done better if we were all together live in a room, what I'm going to walk you through. But when someone in a room stands up, and every time he stood up, a bunch of other people, see how I this is hard to explain unless I can move people around. But when you get any cause and effect, and guys that have been in the pit, Paul, I seen that you're here. He's an old pit trader. Ed is here. When you get something new to appear in the market, the seller who's got a lot of selling, hey, he could be up 1,500, 2,000 contracts, even though he's showing 20. But when you get new something that hits the pit, that hits the market, in this case, our domes and this screen, you get a lot of followers. You get a lot of people to do what that guy is doing. And so they run away from that order because they all want to do what he did. And remember, they sold it or they're chasing it to try to sell it. And so a lot of shorts underneath that order get accumulated, correct? Creating, when you're short, not a seller, when you're short, you're a buyer. And I'm repeating this because it's important again and again and again. Not when you're a seller, you're a buyer. When you're short, you're a buyer. And if you accumulate enough shorts, you accumulate enough buyers to make this area unique. And you run back to where you started. It's not arbitrary at all that markets run back to where a lot of open positions were opened, because the shorts turn into buyers. And not only do they buy it back up, but they run out of buyers around where they mostly open the position, because that's I'm not going to do worse than a scratch moment, break even moment. How many people think that? When you have a winner, you're short at this X, it goes down 2 points in your favor, comes back up, you're a buyer, and finally just puke it at a break even. Tell me that's not a realistic feeling everybody has had over and over and over and over again with winners. And just think of the example of being short. You're a buyer, you don't get filled for your target, and it goes back. Maybe you're not chasing it up, but when it gets back up to break even, or the whole break, I hate people that do break even plus one, whatever, boom, they're out. And then it goes back down. And you ever notice, you're like, why did it go? That's because there were too many people short in that area. And they had the same thoughts as you. I'm not going to let it go beyond a scratch. I'm not going to let it go and go against me. I'm not going to let a winner turn to a loser. So the market runs out of buyers at just that short, that small moment in time. And then wham, it'll go down. And that's why you see it again and again when these icebergs appear. This is the almost every step, every step in that process. What pushes it down is a question. The very beginning, when a new seller appears, you get followers, people opening up shorts or wanting to open up shorts. So they sell it. They're reaching to sell it. People who are long are like, shoot, I got to get out. But people who are followers sell it to get short, and they chase it down. That answer your question? That's what pushes it down. When a new seller appears, generally the market runs away from it at first. It's a magnet because there's a lot of shorts opened up because of that seller, so they buy it back into where a lot of shorts opened up. It's taken out because people are leaning on it who are short. Shorts who are leaning on an order are buyers that try to buy it through the order as it's getting traded. And generally, most of them miss it. We want to be long in anticipation of it not only retesting the sell iceberg, but blasting through it. And there's techniques to buy momentum through it. There's techniques to play it from the long side. But knowing that there's a magnet is the best ready in the ready, aim, fire that you could have. So let me read this question again, because other people have this question, I guaranteed, but aren't asking it. So let me read this question. Let me answer this question. So when the iceberg appears, what makes it go down? People trying to get short, follow the order, which is sell it to and open up a short. They all try to do it. That pushes it down. Got it? What makes it come back up are the people who sold it and got short became enough buyers to make it a magnet and draw it back up where this whole story began. So the shorts become buyers that draw it back up. What initially makes it come back down? You run out of those buyers who aren't going to do any worse than a scratch. What makes it go back to it and then through it is because you always got people that are still short from it or short period and are leaning on that order to get out. They don't have to be short only because of it. They could just be short. And they're going to lean on the order. There's a video I did on leans in the Edge Course 4 that I'd want everybody to watch to understand why an iceberg, well, eventually it'll pop through it. Now, you guys that have been in the room the last 2.5, 3 weeks, you've seen this happen over and over and over again. Have you not? That's right, John. They become buyers. They just want when people are short, they're all that they become buyers. And he puts it, they get cold feet. Exactly. They became buyers and they get cold feet because they seen their winning trade turn into a less of a winner, less of a winner, less of a winner. Screw it. I just want it out. And those, John, are the people who get short because of the big iceberg. Boom, they see it go their way. They don't get filled for their winner. Now, don't take this as everybody who sold it in here doesn't get filled for a winner. All right. We're going with the herd. So the ones who sold it up here or chased it down here, got short, become buyers. They chase it back up. And it's unique that that's where the whole game started. And then at some point, they're going to just blast through it because the shorts who are leaning on the iceberg to exit their short will buy it all up. And it's a self-fulfilling prophecy. Remember what a sell iceberg is. It's someone selling a bunch of what? Contracts. That's what you need if you are short. This is what I don't think people understand, and they should. When you're short, you're a buyer. What do you need? Sellers. If I'm a buyer, I need sellers. That's what makes a price trade. So if you're short, you're a buyer. Follow the progression. If you're a buyer, you're looking for sellers. If there's a lot of selling, you're like, you know what? I don't have to get out of my short until this big order goes away. Until, I've got plenty of contracts to buy and lean on, literally lean on. But when that lean fades and goes away, it's like leaning on a wall. And the wall falls down, you fall down. Forget about the guy who's selling it. The iceberg. Forget about that guy. Forget about him. Just worry about what he's doing. So it's a good question. The sell iceberg and the guy who's doing it, doesn't he want price to go down? Who cares? Yeah, but he might be doing it for a spread. He might be doing it to hedge his long exposure in stocks. He might not give it a SHIT if it goes down. He's not necessarily just selling it to get short. He's selling it off a hedge. So if he got it there, if he got it lower, if he got it higher, it all fit into what he was doing. Who cares? All I know is he's a new seller, came to the market and created this dynamic. When the dynamic is, and we'll build on this webinar, but when the dynamic is, there he is, he's chasing price. He's not just chasing price lower. All the followers are lower, lower, lower. Everybody in that quick dynamic leans on him. He's done. Boom. You get a pop. That happened today. It happens, I don't want to say once a day, but it happens a few times a week. Where the iceberg, not that the iceberg shows up, that happens more than a few times a week, but that where he chased the market down, then he could pop. The difference between an iceberg, guys, and a guy showing his whole order is the one guy showing his whole order of 515 contracts. An iceberg is only showing 20 or 23, but there's more than meets the eye. You don't know if he's going to end up doing 500,000 or 2,000. All you know, he's got more than 23. And Dave's keeping track on how that's accumulating. So we'll know how many he's done, how many he's showing, and how many he ends up doing when he's done. Just understand the dynamic. A big sell order comes. A lot of people try to sell it to get short. Some actually get short. Many do. They become buyers, which chase it back up. You run out of buyers who are the ones that just, like John said, get cold feet, chase it up, and don't want to do any worse than a scratch. So first time is a little resistance. Eventually, so that's why it's a magnet. And eventually, you're going to chase all the shorts out, whether they're short because of this guy or just short. There's always people short in the market. And they're going to lean on that. And once it's gone, so is price to the upside. Guys got to watch that that session on leans that I did long time ago, but it's obviously still very relevant. In fact, as we're talking here, I'll give you guys the title. Pop in your questions as I'm looking for this. I know you guys got questions. I'm not going to cover every single aspect of how to trade it. I just need you guys to understand when it appears, why it does what it's been doing, because you've been seeing it happen in real time. Let me ask you guys that question. Have you guys seen this happen and recognize this happening in real time, and Dave and I explaining it over the last 3 weeks? And I'm getting a lot of yeses. Good. So now you have the understanding of why, as Dorian put it, the governing principle behind it. No, you can't. Someone asked, could you spot it on the dome? There are third parties that allow you to see. That's what I mean. This isn't like the what's the word? It's great and awesome the way Dave displays it. There's other third party software that displays icebergs, but the dynamic of how to use them, what's important, these big buyers and sellers that he is able to show. The stuff here that we collaborated is not on third-party software. This stuff here that I'm not going to talk about right now or today. And then these zones that he has is a combination of a couple of things I'm not going to talk about today. But putting everything on one screen and then magnifying it down here is what's unique, important, and simple, right? Always hitting back on the simplicity. So no, but you don't just see it on a straight dome unless there's some third party. And I'm not really familiar with a lot of the third party software. I could care less about it. A lot of the third party software is too noisy. So here's a good question. An iceberg is an indication of a lot of orders with only a few being shown, right? Yes. Where are the rest of the orders making up the iceberg? He's hiding them. They're there, but the exchange allows people to use the idea of an iceberg to only show a certain amount. They're at the same price unless he moves them. So this is a good question. The rest of the orders are at the same price. And in this example, I'm just staying with a sell iceberg. Let's just stay on the sell side. Their offers. We know how many he's showing, but we don't know how many he has until the end. We know how many he's showing, how many he's done so far. And then when he's done, we'll know how many the whole order was made up. But they're at the same price, Ron. They're not above or below. They're at the same price. And if he moves it, you'll see the line move. So when it's moved, you'll see the line move. All right. Another question about buying into the iceberg that turns them into sellers. No. First, use the iceberg as the people that buy into it generally are the ones that are going to chase it and have a nice pop. Okay. Because they're shorts and they're using the iceberg as a lean. The momentum traders that you're saying are now become longs, and there's a lot of momentum longs turn into sellers, will sometimes drive it back to that iceberg, and then it might bounce from there. But you're taking another step. You don't. The key with icebergs is you don't want to be short. You want to play it from the long side at some point, thinking that it's a magnet and they're going to blow through it. If you can get short close to it, yes, but you don't want to be short and reach from it. The impulse move of it blowing through, Dylan, is not people opening up long positions generally. It's shorts using it as a lean. And when you watch that video, you'll understand more about shorts puking and then they're chasing. When I say puking, don't correlate it with this just yet. They're short and they're using the big sell order as a lean. This might sound confusing, but it shouldn't be. When you're short, you're a buyer. When you're a buyer, what do you need to get out? Sellers. Now, before I answer another question, let me, oh shoot, some of my videos aren't coming up. You guys having a problem seeing my videos on the website? Oh, I'm on the wrong page, first of all. Hold on, let me find this. I got to find this video and get it out of the way here. Ooh, I think this is under that. I got to fix something on Vimeo because it's not pushing videos to this. So email me, but it's the video on leans. Some of you guys might have seen it. If you know which one it is, type in which course and which lesson. In the meantime, let's answer some more questions. Not yet, John. Just hold on to that. All right, Ron, that means I answered it, right? Kenny, I get into that another time. All right, so this is a good question. You don't know. The question is, how do you know there's an iceberg if there's only 23 showing? Well, I won't get into how, but the way that Dave has it set up to pull in and recognize the order. And you see it as a red line on this screen share that you guys have been seeing the last couple of weeks. So just know there's more than meets the eye. You know, the video has a picture of a guy leaning like on a wall. If you guys remember watching that, try to find that video. I don't know if everybody's having trouble with the website in Vimeo or just me, but I have to go and check that after we're done. I'm going through your questions. Dorian's got it. Course 4, lesson 1, topic 3. Course 4, lesson 1, topic 3. Are you able to see the videos right now, Dorian? All right, good. So it's working on your end. All right, Paul, take care. Is that got the picture of the guy leaning on the wall, Dorian? All right. So that's the one I want you guys to watch. Course 4, lesson 1, topic or video 3. Course 4, lesson 1, topic 3. So Bruce says what's interesting to him is not so much the iceberg that you could see, but the refreshing of the bid offer on the down, but having an iceberg step down, all right, and maybe multiple times, and then seeing when the selling or buying is complete. That's when you get the pop. So yeah, and you get, that's what I said, you get a few times a week, which you actually now could see and follow. Yeah, there's something with Vimeo, but I'll fix it. It's happened one time a year ago. So you're not able to see it then, Dorian. Yeah, I'm getting the oops. It's usually on Vimeo's at end, and then they fix it. So enough about that. When it's back online, this happened about 8-9 months ago. It took like an hour or so, and Vimeo was back. So when it's back, make sure you're logged in. Course 4, lesson 1, topic 3. So this session, Sandy says, is just the tip of the iceberg. Indeed. To all of this. Which just becomes a pretty remarkable collaboration of everything that's important for a market and understanding it, and just, the overlap of all the why moments, not just order flow, but other people's positions, all kinds of stuff. So when you're in the room tomorrow, you have a much better, and days after, much better understanding of this. We're coming up with a way to make this viewable all day long, even after 10:30, after the room shuts down. But hang tight for that. I need to give people a sense, a preview kind of sense of how icebergs are used and the value of them. And if you don't know the dynamic of what it is, and you trust that there's more there, you're not going to ever be able to use it to your advantage. And trust me, there's a huge advantage if you haven't already been able to glean from seeing it the last couple 3 weeks in the analysis around it. Any other questions? Don't overthink it. Don't overthink it. A big seller appears that more than meets the eye, new information. People do what the iceberg does. It's a magnet because they do what the iceberg does. And then people lean on it. And in this case, shorts are leaning on a seller, because after you're short, you're a buyer. When you're a buyer, you look for sellers. They nibble, 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 nibble into it, and then they move. It's almost like if you You can look at a lane being like a funnel. You know what I mean? With not water running through it, but a bunch, they squeeze in through it, and then they finally fit and they're able to go because the other side opens up. So everybody's a log jam, and then once they get through, it opens up. You got to click on the Edge Elite tab, John. You do have it. Edge Elite tab. Now, coincidentally, Vimeo's having a problem, so you guys are going to go and watch this and then tell me that you're getting an oops message. So you're just going to have to wait until Vimeo is having a problem on their end to when it's fixed. When this happened before, it was like an hour or so. Just remember the course for lesson 1, topic number 3. Some are working, some are crashing. Yeah, that's what happened last time. Those that have access to course 4 are those that are Edge Elite members. So if you're not an Edge Elite member, you're not going to have access to it. But you got to go to the Edge Elite tab at the top, and then you'll see course 4, open it up, and you're good to go. In fact, let me pull down my chart. You're going to see this. Oops, you should see the video. But if you go to Edge Elite, you go to course 4, you go to, what lesson was it? I forget now. I said it a million times. Lesson 1, topic number 3. And when Vimeo's back up, you'll see the video here. It should have a guy leaning up against the wall, right? That's the picture. That's the picture of that video, right, Dorian? Man, you become one of the smartest guys in Australia. No, I'm going to stop the recording. Give you guys a couple more minutes to ask questions. But that's going to do it for this session. Just remember, this is relevant to guys who are watching it live and maybe not so much for guys in 6 months or 8 months, but it's April of 2020. You know what's going on. The higher the risk, the lower your size. You have no choice but to take more risk. So it's important for guys who aren't in the room every day to understand that by clicking your mouse in this environment, you got more risk. So the only way to manage that risk effectively is to cut your size. The micros allow you to trade less than 1. All right. That's first off. In a prop firm, a lot of stuff would be managed for you, and you wouldn't be able to do some really dumb things people do because accountability is front and center. Risk management is front and center. Unfortunately, it's not when people open up their own independent account and they try to trade without that accountability first and foremost. So just remember that in volatile markets like we're in now, you have no choice, but you're going to take more risk when you click that mouse. In order not to feel it and still be objective, you got to cut your size or you won't be objective. You'll be, I'm willing to take more risk. You're still not going to be as objective as you need to be. So there's going to be stuff right in front of you when you're emotional that you should see, read, and understand that you miss. When we're emotional, we miss what's right in front of us. And what's right in front of us is most important. So cut your size.